It is my pleasure today to introduce our next panel, led by Entrust Capital Managing Partner Greg Heimowitz. Greg founded Entrust in 1997 following an investment career at Goldman Sachs. Entrust, whom I have the pleasure of representing here in Canada, currently manages approximately $9.5 billion for over 340 institutional investors and even more family offices and high net worth individuals. The firm is 100% employee owned and is headquartered in New York and has offices throughout the world. Entrust exclusively focuses on hedge fund investment solutions through various multi-manager offerings, strategic partnerships, and opportunistic focused investment vehicles. With over 10 years of experience investing in activist strategies and over $2.25 billion invested with activist managers, Entrust recently launched its Global Activist Fund on November the 1st. Entrust believes that Global Activist Funds is the first investment vehicle to provide investors with access to a portfolio of well-established activist managers through a dedicated co-investment option. Activist managers invest in public equities and attempt to create catalysts to drive stock appreciation, and we believe that this proactive approach makes activist strategies a compelling alternative to traditional long-only equity investments. Today, Greg is joined by two of Entrust's activist managers, whom I'm sure many of you know. Nelson Peltz is CEO and founding partner of Quadrant Fund Management. Founded in November 2005 by Mr. Peltz, Peter May, and Ed Gardner, Quadrant Partners seeks to invest in undervalued and underperforming companies and works closely with the management of those companies to enhance shareholder value through a combination of strategic redirection, improved operational execution, more efficient capital allocation, and stronger focus. Over the years, Quadrant has been actively involved in names such as Pepsi, Heinz, Kraft Foods, and Cadbury. Keith Meister is founder of Corvex Management LP, which looks to identify and invest in event-oriented situations where there are multiple paths to value creation. Activism is used as a tool of influence to influence outcomes and improve the risk-reward characteristics of a situation. Corvex has been actively involved in names such as AboveNet, RALCorp, and Corrections Corp. Prior to founding Corvex, Mr. Meister served from June 2002 to August 2010 in a range of leadership roles with Icon Enterprises, the organization headed by Carl Icahn. And if only an activist manager could be used to help remove a particular drunken or smoke-cracking mayor from office, we'd be in a better situation here in Toronto. And so without further ado, I turn the mic over to Greg.
Thanks, Rob. Well, thank you, everybody, for joining us. Nelson, Keith, and I have done this a few times, although sometimes we have more than just the three of us. But what we're going to just sort of do is engage in a little bit of a dialogue, and then maybe someone tell me when we're sort of 20 minutes out, and then we'll open it up to Q&A, and I'll stop asking questions, allow other people to ask questions if they'd like. I've had the great pleasure of working with Nelson and Keith for many years now, and it's a real treat to have them both join me today here to talk about activism and what's going on in the space. So I thought I'd start with the younger guy, Nelson. And why don't we just sort of talk, Nelson, first about why there's such an intense interest in activism. You can't pick up the newspaper any day without an article. Today there was an article in the New York Times, another article in the FT, all about activism. What is going on right now that makes everyone so interested in this space?
Well, first of all, let me say hello to everybody. Thank you for coming today. Before I answer the question, Keith and I were very saddened to learn that you've only have $2.2 billion in activists. We think by the end of the day you should raise that number. It's very newsworthy, it's very exciting. I've been doing this only since sometime in the 80s, and I still enjoy it. I think we get a lot accomplished doing it. But what it does is it gives us, as activists, the ability to take somewhat of our fate in our own hands. And I think what it's become somewhat of an offset to private equity. And we've seen over the years where private equity can invest in a company that some fund may have an investment in for 20 years and make a 3 or 4% IRR, and then some private equity firm comes in and puts some more leverage on it, et cetera, and doubles or triples their money in 3 or 4 years. I think that the interest in activism is because it allows this great transfer of wealth that we've seen over the last 20 years to private equity. It gives the public shareholders an opportunity to benefit a little of that without having to be in a private equity fund. And I think, for the most part, some of my fellow activists are very colorful figures. They like to be on television. They like to be in the news. I don't think that's particularly good for activism, but I think activism as such is very good for corporate America and for the corporate world, because it gets boards and managements the ability to work better and work smarter.
Keith, well, why don't you answer the same question, but just picking up on Nelson's point, what has changed, if anything has changed in the environment, to allow a guy, investors like yourselves who own relatively small percentages of companies, like one of our other managers owned 1% of a company, one of the largest companies in the country, and the CEO left. What has changed in the environment to allow you guys to have the level of influence that you do now in companies, juxtaposed to private equity where they have to own 100% of the company?
Well, thank you, and I'm thrilled to be here, and it's an honor to sit on a panel with Nelson, so it really is. And I'd add one point to what Nelson said before I answer Greg's question, because if you think about what Trian's doing and other active firms, there's really no reason private equity should be able to take a company private at a substantial control premium if other shareholders let people like Nelson do what they do really, really well. So you don't, I heard a smart activist investor once say, and I didn't give it enough credibility until it kicked in, which is if he invests in a company and the exit ends up that you sell it to private equity, he failed. Because all the things that private equity is going to do to make investors like you a 20% return, you really should be able to do for the most part, save a handful of special situations where there might be a really hard turnaround where you got to get smaller to get bigger. But most of the things that private equity does, you could probably do in the public markets. So that's the lead into your question. So why are activists able to do it now with 5% or 10% as opposed to 100% of a company? And the answer is the world has changed. So when Nelson and Carl Icahn started doing this, decades ago, the mutual funds thought, or the institutional investors thought of the active owner as the bad guy. Today, after many, many instances where they've partnered with the owner and made money, we're the good guy. I tell the analogy that I'd imagine 2 decades ago, if you make up the proverbial guy at Fidelity, call him the proverbial guy at Icahn, he'd probably sneak out of his office, make sure no one knew he was calling, and say, hey, take a look at XYZ, worried he'd get fired for sharing an idea with the bad activist. Today, they come in your office, they say, here's our portfolio, here's our troubled companies, please help us. And I think the reason is everyone's competitive, everyone wants to make returns, and the world's changing from passive managers, the index funds, the Vanguards and the BlackRocks, and everyone else. And somewhere on that spectrum is Fidelity and Capital World at the left side, and somewhere farther to the right are guys like myself and Nelson and then Carl and whomever else. But everyone along the way is active in their portfolio, and the media chooses to bucket it, call it activist. All we're trying to do with different styles and different abilities for affecting change is trying to get companies to do the right things to create value. And if we're taking the laboring oar, other shareholders are welcoming that because they need to see the returns and they make us more powerful.
Keith, what you said is absolutely true. The same words, you can put quotes around them, that I say to managements and boards today, they do listen. The institutional investor has changed his stripes. He always believed that for many years he had 2 choices. If he didn't like management, he'd either sell his stock or hold his nose and check the proxy card. But those were his only 2 choices. Somewhere along the way, they realized that they really own these companies, and people like us can help them achieve their potential. But the same words that I can utter today to management and a board and an institution, saying those same words, and believe me, I use the same words because the same issues were at hand in the mid-'80s. I was called the green mailer, I was called a raider, and then it went downhill from there. And we never green mailed anybody and we never raided anybody, but those were just easy things to say when really what we're trying to do is get these companies' income statement to work a little better. And we give them suggestions, how they can get sales up and put a lid on expenses, how they can move the company along at a better pace. Today we're having conversations with Mondelez, a company, it's a wonderful company with a terrible name, and we were very much involved in creating that company as an activist. We had 1+% of Kraft at Dow stock. We convinced Kraft to buy Cadbury. We convinced Kraft then to break up into two pieces, Kraft and Mondelez. And yet we talk to Mondelez today and we tell them that their margins are ridiculously low, their working capital is ridiculously high, and we give them examples on how they can fix that. We give them examples how a company 1/3 the size of Mondelez does about 35+ billion in sales, and Heinz, a company we were very involved in, did at the end when it was sold, I know, Keith, it was a failure, it was sold to private equity at $72.50, we bought it at $30, so it wasn't that bad a failure. This company was doing 12 billion, so 1/3 the size, and you look at companies and say their SG&A as a percentage of sales is 50% higher, and their working capital as a percentage of sales is 80% higher, and you start to point things out, they have to take action. They have to fix these things. And in the old days, they would just ignore you. And I think a lot of this occurred by accident. It occurred through Sarbanes-Oxley when lead directors were created and executive sessions becoming mandatory in board meetings. All those things really created a better environment for activists. In the old days, if you were on a board, the chairman really didn't want you to have offline conversations with your fellow directors. I was on a board and that was verboten. Today it's mandatory. Today there's a lead director who's got to take the call from the shareholder, whether he's a 1% holder or what, and he's got to have an ear and he's got to listen to what you've got to say. That doesn't mean they're going to do it, and most often they don't like it, and when you arrive, they don't pop the champagne corks, but now they have to listen.
Let's try to demystify activism a bit, and you guys could both answer this question, but I'll start with you, Keith. What are the kinds of characteristics of the businesses you're looking for? Do you plan an engagement before you actually buy the stock, or are you buying cheap companies, undervalued companies, and once you get in there, you recognize the fact that it requires some activism? Sort of walk us through. You could use real live examples if you like, but walk us through and demystify for everybody what it's really all about and how you guys do it.
So I think demystify is a good word. For some reason, people love the concept of activism. I would argue that most of the activists' return is going to come from being a good fundamental investor. So it all begins with, we're looking to buy attractive companies at good valuations, great companies at good valuations. Now usually, when you buy a stock or bond, what you're really doing is investing in how your future expectations are different than the markets. So if I buy a stock, someone else is selling it to me. So I have to have a different view of what the future is going to look like. And the market's usually pretty good, given the existing facts and circumstances, at pricing in what a business's future cash flows might look at. So how they're going to run their income statement, how they're going to allocate their capital, because most businesses have plans. And sometimes those plans create value, and sometimes because of agency issues, because of bad management, bad execution, they get discounted in the markets. So if you can invest in a situation where you have an expectation that's higher than the market, you're probably buying a security at an attractive valuation. The challenge is, what's going to cause it to misprice? So if you invest in an oil and gas company that's worth $100, and they spend $20 every single year allocating capital, and they're bad at finding new oil and turn that into zero, eventually the company is worth a lot less. If you invest as an activist, if you take a position, sit with the management team and say, hey, for the last 5 years you've been really bad at finding oil and gas, maybe this is a trend, maybe we should do it a little differently, and get them to change, as just a made-up example, how they allocate capital, you have an opportunity to create a bona fide arbitrage, because there's going to be a different set of cash flows in the future. So the ability to have your returns correlated with that change, to have them less path variable, to have them less correlated with the markets, and to change what the future path may look like is a way to create a path to getting paid, to realize your expectational gap, to have your non-consensus view become consensus. But at the end of the day, if you're wrong about the business, there's no amount of financial engineering the activist can do. The asset price, the asset value has to be higher than the share price. And as long as that asset value is higher than the share price, you can do the right things to change how the business works, how it allocates capital. But if you're wrong about your fundamental investment tenet, there's no way to make it work just because you're actively involved unless you can change the value of the business. So at Corvex, we try to invest in good businesses that are going through change, try to invest in things where we're hopefully going to make money because the investment's good. We understand the fundamentals. We understand the change. And then we can concentrate, which is the core in our name, Corvex, core value cross capital structure, in situations where we understand the fundamentals, there's some change causing a good company to trade at a great valuation, and we have the ability to actively, hopefully, either accelerate the realization, which would increase our IRR, or lower the risk, or increase the probability that that event occurs by being actively engaged. And I would tell you why there's lots of different examples, and I'd love Nelson's view on this. At the end of the day, it's usually not because of bad actors. It's usually agency issues that you're trying to change. When we come as shareholders, we usually care about being an owner of the business and what's going to create the most share of value over 1 year, 3 years, 5 years. Businesses have lots of other stakeholders. And if you're on the board of directors of a company in the average town in America, in St. Louis, you know what? You may have a duty to that town in your mind. And you don't want to do something that's necessarily, it's hard to do something that maybe reduces jobs or does a merger with another company. It might be the right thing for shareholders. You might not be a bad person, but you'd prefer to try and believe in the business. You'd prefer and try to have some other solution. When there's an owner in the boardroom, sometimes that dialogue changes. So I don't think activists necessarily in most of the situations we look at, and I think the situations Trian looks at, we're not investing with bad actors. We're not investing with bad people. Life's too short. We usually try to avoid that. But we're investing in companies where somehow they have the agency issues not skewed enough towards the equity. And by thinking like an owner and making some changes, you can price in an outcome or return that's not in the market. But there's no playbook. Sometimes you talk to management beforehand. Sometimes you don't. Usually when we file a 13D, we try to call a company and explain to them that it's a good thing. The first reaction from a company is, oh no, an investor's filing a 13D. We try to flip it and say, look, calling to tell you, we've talked, we've bought a lot of your stock. This should be a good day. Hopefully there's a smart guy that thinks your stock's worth a lot more. We want to give you capital. We want to invest in your business, and we have ideas of how you can create more value. So it's trying to convince management and boards that it's a good thing, not a bad thing, which is a change.
That's a tough sale, Keith.
Yeah.
We look at businesses very differently. We look at businesses as owners. The background of the partners at Trian has been operating businesses. We built and ran and sold a Fortune 100 company in the 80s. We've noted for turnarounds. We started our fund for the first time taking in third-party capital, as Greg told you, at the end of '05. So we specialize in a limited group of industries. We have roughly 8 to 10 positions at any one time, so we're very concentrated. The first place we look at a company, we look at its income statement. We want to know what we can do to that income statement to get it to do better, to get this company to start to achieve its full potential. On our coffee mugs in our office, you'll see everyone says, get sales up, expenses down. That was my father's secret formula for success in business. After he told me that, I left the Wharton School and felt I knew all I needed to know. So when we look at a company, we look at, yes, values, the multiples that are trading at are interesting, but if they achieve all or some of what we're suggesting, what are we really buying this company at? A company might trade at 12 times EBITDA. Pepsi trades at 12 times EBITDA. We think we're buying it dramatically less, maybe half, if they do everything we suggest them to do. Then you want to manage risk-reward. We think the formula we have is asymmetrical when it comes to risk-reward. We're buying into much larger cap companies. These companies, they're not going to double over the weekend. They're not going to catch cold and die either. These are companies that don't have to make a 180-degree turn in order to achieve full potential. Some of these companies are generating so much free cash flow today that if you just refocus them a little bit, that cash flow can grow dramatically. At Heinz, they were generating about $800 to $900 million a year in free cash flow. We had to get a proxy fight. We had to have a proxy fight to get 2 board seats. When we were done, they were generating about $2 billion of free cash flow. The stock went from 30 to, when Buffett bought it, at 70, 250. Earnings per share doubled. It stayed investment grade all the way through. And we changed a lot of things in that company in order to make it work right. We accomplished the same kind of things in Cadbury. We're expert in certain fields. Okay, we stay away from commodities. We can have the best run company in oil, and if oil prices go down, it's beyond our control. If they go up and it's badly run, that's great, but it's also beyond our control. We stay away from high-tech, biotech, plain, simple businesses. Everything consumer, that's retail, that's consumer products, restaurants, what we call financials without balance sheets. I can't tell you what the balance sheet of J.P. Morgan looks like there. I can't tell you if it's good or bad. But I can tell you about Lazard, I can tell you about State Street, I can tell you about Legg Mason. And then industrials, where we've been involved historically in industrials. We're involved in Ingersoll Rand right now, have a board seat there. So these are the kinds of businesses that I think we are expert in. We can have a eyeball-to-eyeball conversation with management and know almost as much about their particular business as they do, and certainly as much about the industry as they do. We have guys who specialize and work in these industries day in and day out. This is where we look for our 8 to 10 investments. So it's a very exclusive club if you make it on our list. We comb hundreds and maybe thousands of companies to find the right ones where we have a formula for success. We have a formula to get that company to do what any one of us in this room would do if we owned 100% of the company. The first thing we say to management, if you owned 100% of your company, would you be running it the same way you're running it today? If all your net worth was tied up in this business, would you be running it the same way today? And if they're honest, the answer's got to be no. They wouldn't do some of the irrational things, some of the waste, some of the lost opportunities that they do because of all of these outside forces. They say, well, Wall Street wants us to do this. I say, you're talking to Wall Street right now, and we don't want you to do it. We want you to do what you would do over the long period of time to create value. We have a long time frame. Most of our capital is long term. We're happy to be in these companies for a very long time, and the returns have proven that.
So let's just stay on that. And either one of you guys can answer this, or both of you guys. What is it, what happens when you guys show up that all of a sudden they get religion and they're like, okay, you're right, we should be doing this, and let's ignore the quarterly estimates that we've been focusing on for the last few years? Why? I'm often asked as I travel around the country, and talk about activism. Why are these guys able to come in and exert this influence? Why aren't the companies doing this already? Is there anything else going on other than the agency issue that you spoke to? What else is happening? Is it a failure of boardrooms? Are you finding management teams weak? What else is going on besides the agency issue?
Well, I think the agency issue shows itself in many ways, but take your concept of boardrooms. How do people usually end up on a board? They usually end up on a board because they're picked by either the other board members or the CEO. And most people who go on a board are well-intentioned. So you may have a consumer company, and there may be someone with marketing expertise who's a CEO of a business or retired who knows the industry, and you put him on your board, and he's there to help the CEO. He didn't go on the board probably to have a fight with the CEO. He probably doesn't own stock. I think one of the biggest ways that you'd have change in corporate governance in America and accountability is if somehow magically you could have every person who went on a big board have to have some portion of their net worth in the stock. If you made board members owners. So if you're a board member and you go on a board because you know the CEO, you're in the industry, you're there to go to the meetings. I find that the meetings, board members are very, very engaged. They want to do the right thing, but they'd prefer not to have the tough conversation. They listen to management go through the presentation, they ask the questions, they go to an executive session afterwards, they say, oh, that wasn't great, we need more of this, we need more of that. Management comes back in and they say, great job, keep up the good work. Meaning, they're not motivated to have the tough conversation and have the fight. Now all of a sudden you put a credible owner in the boardroom who has 1 board seat, 3 board seats, whatever it may be, and I don't think you need to have all, but you're part of the dialogue. I think all of a sudden the other 8 or 9 board members become better directors. You have the ability to force a little leadership. They can blame it on you a little bit for why they're holding the CEO accountable. They can make you a little bit of the bad guy while you're trying to be constructive. And, boardrooms are a phenomenal exercise in leadership. And many boards end up not being as good as their individual sum of the parts. And some boards with strong CEOs change that, or strong chairmans, or I'd argue some boards with strong owners can change that. And the risk is when you go in the board, they can choose not to listen to you and you can be neutralized. So their greatest defense could be, hey, Nelson, have a board seat, and then just not listen to you. I would argue
that only lasts for 1 year.
Yeah, and I would also argue it's rare, because I don't think in most situations the guys are bad guys. If they look up and say, oh, Nelson owns lots of my stock, he wants the right thing, he's got a team, they're doing the work, they're knowledgeable, I think you end up more often than not, you don't get everything you want, but you're not paying a control premium. But you get a lot of what you want, and as they start doing the things and it starts working, they do more. So I think you just make the pieces better.
Take us inside H.J. Heinz.
Okay.
Take us inside H.J. Heinz. You and I were there at the very beginning when no one wanted you involved. But maybe just briefly walk us through what you saw. Just same question, right? Related to what happened in the boardroom when you got on the board, the relationships with management, and what did you see when you got there, and what did it look like when you finally left, when Buffett ultimately bought the company?
First of all, I got to tell you, of all the boards that I've been on, and I'm on a lot of boards, that one wound up to be the best board I've ever served on. It had some of the smartest people, former chairman of U.S. Steel, current chairman of Marathon Oil, the current chairman of Covidien, the former chairman of Praxair, the chairman of PPG, Sunoco, on and on. Really good people. Not one consumer guy on the board, or woman. But they were smart enough to know what they didn't know. And when you show up like we did in '06, and that was early days by comparison to now, and we went to them with a white paper, and I'll give you, if you want me to give you the history, the company, the stock, sales and earnings at Heinz before '06 had gone down 9 out of 10 years. Still investment grade, paying a 4% dividend, stock 30, but a negative outlier, the most negative outlier on the S&P packaged food index. And why was it? When you're in the middle of a quarter and you're the CEO, and the CFO comes running into your office and says, we are not going to make consensus this quarter. What can you do? The only expense that we've seen that somebody can have an impact on in the middle of a quarter is direct marketing. No more TV. No more internet. There wasn't a lot of internet back in those days. Shut it down. You shut it down, you struggled to the end of the quarter, and you made your numbers. What do you do now? Your sales are not going to pop in the next quarter because you cut all your marketing spend away. But you can't let sales go down, so you give bigger discounts to retailers. You do what they call deals and allowances. I'm going to pay because I want my ketchup to be on the eye level shelf. I don't want it on the shoe level shelf. I give a bigger discount. And when you looked at Heinz numbers over a period of time, and the board didn't really understand these numbers because they weren't consumer people, you looked at these numbers and you see that these discounts were 22% of sales. Here was a company doing $8 billion when we got there. Sales were 22%, discounts were 22%. And yet direct market spend was only 1.6%. This is a consumer products business. It's not a local utility. We told them they had to change that. We told them to take money away from the discounts, put it on television, put it on the internet, create demand for the product. They understood that, but if they risked that, sales would fall, and they weren't a loved company on Wall Street at that point in time. They would be less loved. So when we put that in a white paper asking for a board seat, they turned us down. When we got our board seats, the board took the attitude, and the appropriate attitude, that shareholders had spoken, and they were going to take our formula on, and it did work, and sales went up. Heinz is the only company in the world that could say that they had 32 straight quarters of organic sales increases, the only company that can say that through this period of time. And that was all because of these simple things that they were frightened to do on their own because they had disappointed shareholders already and disappoint them a number of times. So the board then looked upon Trian, and not just me, but looked upon Trian as their resident expert in consumer, all things consumer, which is what this company was. And they leaned upon our people, and everybody at Trian, when we get on a board, signs a CA, so we get to see all the inside numbers. And there's a lot of conversation from salespeople to the CFO to people in our organization. It doesn't always come through whoever is on the board. And Heinz turned around as a result of that. And those directors who I fought in a proxy fight are some of my very good friends today. And very proud of the relationship I even have with the chairman, who was the chairman prior to our proxy fight and post our proxy fight. So that's an example of a great board. They put up the barricades initially. Other boards I'm on are not so wonderful. They like the status quo. You've got people on boards today who make roughly $250,000 to show up for a number of board meetings a year. Some of them are academics, retired academics. I have nothing against retired academics, but they might be on 4 boards, so they make $1 million a year, and that's very important to them, and I understand that, and they just don't want anybody rocking their boat. And I'm not just picking on academics, I'm just giving you an example.
You want to talk about Motorola for a second? And just what time does the panel end? I'm sorry. 20 minutes. Okay, got it.
So I was on the board of Motorola, and if you think back a decade ago or 20 years ago and someone would say, what's happened to the world? And you could buy one stock, you probably would have said, I'm going to buy Motorola, this whole thing, cell phones, wireless, and this was a $50 billion revenue company with every bit of IP, as strategically positioned as you could imagine. And when we invested, the company had started to fall apart because they missed something called the smartphone, and they missed something called 3G. And Nelson's story made me think about something. There was a quarter where Motorola was the darling. They were selling StarTechs or Razors, and everyone was buying the Razor, and the stock just went up. I think it had a $60, $70 billion market value, and sales got a little slow. And the head of the mobile device business, he wasn't going to miss his numbers. There was no way he was going to miss his numbers. And there was a smart executive at Qualcomm who knew Motorola had some problems, but really wanted to license some technology from Motorola. Motorola, without the board, I don't think knowing, an executive at Motorola licensed basically its rights to 3G before the iPhone to Qualcomm so they could make a quarter. And just think about that. Qualcomm today has a $100 billion market cap. The mobile device business at Motorola was successfully spun off, fixed, and sold to Google for $12 billion. It did okay, but they mortgaged their future so they could make a quarter. That's just a real-time example of something you saw firsthand in one of the biggest businesses with a great board, the chairman of AT&T, the chairman of JP Morgan. I mean, the who's who of the world was on that board. Everyone meant well, but there wasn't an owner.
Before we go to questions, and we'll go to questions in 2 minutes, I just want you guys to answer one more general thing which we haven't touched upon, and both you guys should talk up to this point. You call yourself a constructivist, right, and you try to avoid the word activist. I want to talk for a second, and then we'll have everyone in the audience, whoever wants to ask questions, about tactics. We're often asked the question, when do you go aggressive? When are you willing to engage in a proxy fight? There's some activists that we have in our portfolio. You guys know Cliff Robbins from Blue Harbor, who refuses to go aggressive and engage in proxy. So just give me a sense of your views on the tactics. Why do you like to call yourself a constructivist versus an activist? The relevance of being on the board. Do you always want to be on the board? Just sort of strategy for a second, and then maybe I guess people queue up by the mics and we'll do questions for the balance after these answers.
What we like to do is we like to present our plan in private to management and the board first. We don't want to go on CNBC for the first time with our plan. We don't want to put out our white paper until we've had a good couple of sessions with management and with the board to let them understand what we're trying to accomplish here, to let them understand what it is they can do, and if they take it on and do it, it can be their idea. Very happy if they make it their idea. That's very important to a lot of these people. Ego is a very important thing to a lot of these boards. It's a big line item on a lot of these management teams. So we try to give them that opportunity rather than blast off right away. If unfortunately they don't take it on, if they give us the Heisman, then what we will do is we will go public, we'll issue our white paper, and we'll take every step necessary to ensure that our plan is used. Or sometimes management says they have a better plan, and we say, you got a better plan, we're happy to go with your better plan, show it to us, get going, and we'll hold your coat and root for you. But they usually don't have a better plan, and we'd like them to execute behind ours. And that's what we do. And ultimately, we've wound up in one proxy fight, and I wouldn't be surprised if we wind up in another one. But we want to give management of the board the first opportunity and the second opportunity and the third opportunity to react to what we're saying, not force them into a public corner to feel that they have to come out fighting. If then they don't want to do it and they don't have an alternative to our plan, well, then we're going to have to take the next steps. And we've taken them before, and we will unfortunately probably have to take them again.
So if I come full circle and say, I began by saying there's index funds and everything else is active investing, and there's many different ways to express it. The key is to do it in the way that's consistent and best for your DNA. So in your Cliff Robbins example, he doesn't do proxy fights, and maybe your Bill Ackman or Carl Icahn example, they're doing lots of proxy fights. Our strategy of activism is much more consistent with what Nelson just reviewed. We probably make 200 investments in the last 3 years. We probably file 7 13Ds, and we only ended up having one proxy fight. We went on 2 boards because they invited us on, where we thought we got rewarded for getting illiquid. You got to get paid for it because you do get illiquid, there's a cost. And we probably had 20 positions you never hear of where we own 4.9% of the company and convince management to do the right thing, to make it their idea and to sell. So, you know, for us, we're in the business of fundamental investing with a catalyst, and then we use activism as a tool. There's no right way to do it. I think the key is to make sure, if you're investing with other active managers, that they're doing it consistent with their DNA, because there's lots of ways to do it and to make sure that their asset and liability match is aligned for how they want to do it.
I guess we'll take questions. Is that what you've been doing? I just got here, so.
As a retired academic, I still enjoyed your talk, but I have a question. I do have a question. I'd like your view on separating the CEO's position from chairman of the board. You have a lot of experience. Have you come to a view whether one is better than the other?
I think it depends upon each company. Most of the companies that I'm involved in, the titles are held by one person. In one case, we have separated those titles at Legg Mason. We now have a non-exec chair, and we have a CEO. I think in that case, it's working very well. I don't think there's a hard and fast rule for separating those roles. I think you've got to look at each situation. Certain places the CEO really needs to focus on the business, might be a little green in terms of dealing with shareholders and dealing with the external issues. Let that fall to the non-exec chair. Certain cases, an exec chair if necessary. We've seen that as well. But I don't think there's a hard and fast rule.
I agree.
Nelson, why did you open up your fund to outside money, and has that changed the way you invested? What would you do differently if you were a private company?
Yeah. Prior to starting a fund, I'd asked my wife's permission if I could make an investment, and I can tell you that her hurdle rate was higher than any of you in the room. And when I told her I wanted to invest in all of these companies, and I saw this big sea change occurring, and there was a sea change that occurred on behalf of the institutional investor, really starting to have an ear to guys like me, I had to take money from other people rather than just my wife, and so that's why we opened it up, and we're able to invest in bigger companies. I mean, we invest today in DuPont, Pepsi, Mondelez. Those 3 companies alone have about a $250 billion market cap. And then we've got some smaller ones like Ingersoll Rand and Family Dollar and Wendy's. So it takes a lot of capital. It was more than I had. And if I had it, my wife wouldn't give me permission to spend it all anyway. So that's what happened.
Hi. I'm just wondering, as a question for both of you, what % of a company you would sort of target and like to own, and do you always have to have board seats? Nelson, it certainly sounds like you do. I wasn't sure about Corvex, but it's really the same question for both of you.
So no, we don't always have to have board seats. Frankly, we'd prefer not to have board seats. If there was a great board doing the right things, that would be fantastic.
You can influence them strongly without the board seats?
Sometimes, you know, if you want your returns correlated to your activism, you probably need to be on the board. But sometimes you can invest in great businesses going through change with good management teams and not have to be on the board. But if you want to control outcomes, it helps to be on a board. If you want to control outcomes, you ideally own as much as you can. Usually, that's 9.9%. When you go over 10%, at least in the US, you take on short swing profits. So any share you buy over 10%, you can't trade for 6 months. The other thing I would add is you disclose a position within 10 days of crossing 5%. Usually when you disclose a position, the securities may re-rate. So effectively, if you look at most active situations, you'll have 7 trading days from when you cross 5% to accumulate shares before anyone knows you're there. And the more you own, the more influential you can be. So ideally, you'll show up with 7 or 8 or 9%, but you can't buy elections. Companies will put in poison pills. and you have to get the other 90 or 88% to vote for you. I think one of the fundamental changes are, though, and ValueAct showed this with Microsoft, a well-capitalized, thoughtful, thorough analysis can get the support of the big long-only and the big mutual funds, and the dialogue becomes a little bit more not, do you own 4% of Microsoft? Yeah, it'd be great if you could, but you own $2 billion of stock. Wow, you're a real player, you're an advocate for change, and Microsoft even has to sit down and engage with ValueAct in a real dialogue. It's a multi-$100 billion company with 2 owners on the board who probably own $50 billion of stock, and they still have to engage because the institutions are fed up with decades of underperformance.
I would just say one thing to Keith's point, and then I'll let Nelson answer also, is that ValueAct, Jeff Ubbins is one of our managers in our activist fund, and it's amazing the story he tells that Steve Ballmer hadn't sat down individually with an investor, a shareholder, in 3 years. Hadn't met with one individually in 3 years, and then Jeff and ValueAct published their white paper, and then the rest is history. Ballmer came by to the meeting at Microsoft's campus, and then it was only a month or two after that Ballmer resigned. The amazing thing about activism over the last number of years is the influence that these guys have had on companies and how little, frankly, of the companies they actually have to own. We saw the same thing at Procter & Gamble when Ackman owned only 1% and the CEO resigned as well. So that's been one of the biggest sea changes, I would say, over the last few years, how much influence you guys have had without having to be on the board and without having to own large positions in these companies.
I agree with that. We don't have to be on every board. We are on a lot of boards, probably more boards than most activists are on. We stay on those boards if we have an investment. Sometimes they won't let us off. That's how much they've loved us, even though our investment has gone down. And I mean that sincerely, because they've learned that we do come to the board meeting with a plan. We don't typically, in the new companies that we've invested, I wish we could follow 13D, but the size of these businesses are biggest investments today are $3.5 billion investments, and none of those are 5% of the companies that we're invested in. So would we like to be on the board of 1 or 2 of those companies? Yes. We don't feel a need to be on the board of every company. It depends on the attitude of management and the board. But these companies that we're invested today, I think they need some outside help.
Over there.
Do you find yourself ever being recruited by passive shareholders, or do you ever reach out to other shareholders before you take a position or a strategy?
Not before we take positions. We do reach out to many, virtually all passive investors when you talk to, whether you're talking to an index fund like BlackRock or Vanguard or State Street, or whether you're talking to Capital Research or Fidelity, you're always reaching out to those people looking for their support, or T. Rowe. And frankly, when you can get those guys to make a call for you, one of the biggest mutual fund complexes around made a call for us at Ingersoll Rand, and that's how we started to get things rolling there, and that's been a great investment for us. So more and more it's slow, but you're finding these passive investors willing to do a bit more. It's a giant step for them. It's a mini step as far as we're concerned, but they're doing it. They're moving directionally correct because they own more of these companies than we do, and it's in their self-interest to have us there and for us to execute behind our plan. And more they're showing a willingness to get involved, to make a phone call, to write a letter, and good things happen when that happens.
I'd add one thing. This becomes a virtuous circle because the bankers, the lawyers advising the companies, the boards, they know that the well-capitalized, that the Fidelities, the Capital Worlds will support the active investors. They know the event-driven hedge funds will follow in because the event-driven hedge funds know the Capital Worlds will support the activists, and it becomes a self-fulfilling process. Our biggest issue becomes the board sits with Goldman Sachs or Morgan Stanley and they say, what can we do to win and incrementalize them? Not what can we do to necessarily create the most value. So working to change that dialogue is still a challenge, but the behavior of the institutional investor, I think, is one of the primary things that's helped allow activists to be so much more successful with big companies and medium-sized companies over the last 5 to 10 years.
When in our white paper, we usually, if it's a consumer company, we will show their top 10 or 20 shareholders, and we'll show them the same names at Heinz, the same names at Kraft, and the same names at Cadbury, and those were all very happy outcomes for all of those institutional shareholders, and we'll show that chart to the board, and we'll say, look, these are the guys who have supported us in the past. These are the guys who've done well by our presence in these companies. We suggest you give them a call and see how happy they are with us as a shareholder, and perhaps you want to think twice about it before you just say no.
Last question. Anyone from the audience? If not, I'm going to ask the last question. Go ahead.
Thanks. I remember...
It's not on the mic.
Hello?
Yep.
Okay. I remember years ago when the terms green mail and corporate raider came along, and another phrase, poison pill, came along. And I'd just like to know today, poison pills, are they what they used to be? Are there still a lot of poison pills every time you go up as an activist? Do they have the teeth they once did? I remember there was a time, it depended what state the company was incorporated, and the poison pill had more teeth in one state versus another. So just talk about the effect of poison pills today.
Actually, I want to broaden that question out a little bit, because you asked the question that my last question. If you actually get the New York Times today, F10 of the New York Times talks about this exact issue, and it talks about the boardroom and tactics vis-a-vis defenses against you guys. Maybe you could talk about the poison pill, but also, have we seen any improvement in defensive measures in the boardroom against activism?
Yeah.
And maybe you both answer that, and then we'll conclude.
Every time we show up lately, the bankers give the example of, well, here's where activism didn't work, and they talk about J.C. Penney. Okay?
I think that's going to keep going for years.
Forever. J.C. Penney should survive and prosper, but we will never hear the end of J.C. Penney. Nobody talks about the hundreds of other examples where activism has played a good part. I think that the poison pill has no impact on activists unless we're going over 10%. And in most cases, the activists aren't doing that. So that's an old defense against a raider, against a hostile tender offer, but not for an activist.
Any better defense measures, though, away from the poison pill today?
Look, what boards will do is they will do as little as they can in order to diffuse what you're doing. Example, we were very gentlemanly with DuPont, and we have a plan for DuPont, and that white paper has not gone out, but we felt there were some very valuable pieces to the DuPont company, and there's way too much overhead at DuPont. When they knew when just before we were going to have our first meeting with management, they announced they were spinning off Performance Chemicals. It's a nice thing. It's about 13% of the company. We're very happy they're doing it, but that was sort of getting out ahead of the main event as far as we were concerned, and that was letting these companies go into different pieces and excel on their own. That's one thing. I think that they'll do whatever they can to discredit the plan. They will have their bankers come in and threaten and tell you all the reasons why you're going to lose, and then they'll offer compromise candidates. Well, you don't need to come on the board. Why don't we agree to a compromise candidate? then, and look, we've made all these mistakes. We did compromise candidates. That wasn't great. Then they'll give you a board seat and they'll have you sign a standstill for 3 years. We did that. That's not a good idea either. So we've been there and done that. So when the banker comes to see us to negotiate, we say no standstills and no compromise candidates, and that sort of shortens the conversation.
Yeah, so Greg and I were having this conversation on the plane up, and I think the more common, they always engage now. They never just say no. They try to be compliant, not necessarily committed to the change you want. But more and more, I think the defense is, the minute an activist shows up, it's going to be, I'll give you one board seat, let's not fight. And then the risk we have is we're on the inside. While we won't sign a standstill, we'll usually agree that as long as we're on the board, we'll be well behaved. We'll always have the right to resign and fight on. But they can really neutralize you if they're not committed to the change you want. So one of the risks, I think, is, and one of the great defense techniques for a company is, oh, you think we have a problem? Great, put one person on, help us fix it, and then they don't have to listen. So I think it's very important. The power of winning, if you want to be on a board, and you think the change comes from being on the board, the power of having that mandate. So you can look at the other handful of directors and say, shareholders elected me because I want these two businesses separate, or I want this change in compensation. Whatever it may be, having a mandate for that change is really powerful. So I think more and more the defense technique will be, they'll say, go on the board. And sometimes that makes sense. We just got to be careful to choose the right situations where we can add value and not be compromised by going on the boards.
Okay. Well, I think I want to thank you guys for coming down. For coming up. I apologize. And, I think everyone in the audience, hopefully you got a lot out of this. These are two of the greatest activist investors in this country right now. And I think they've made a lot of money for our investors. I continue to believe that we'll continue to have that. And I want to thank them for coming. And thank you all for listening to us. Thank you.
Thank you.